Hello and welcome. In this course, we will explore events after the reporting period, based on International Accounting Standard 10. The International Accounting Standards Board, IASB, adopted IAS 10 events after the balance sheet date in April 2001. This standard had originally been issued by the International Accounting Standards Committee in May 1999. IAS 10 replaced parts of the earlier version of the same standard, titled IAS 10 Contingencies and Events Occurring After the Balance Sheet Date, which had been issued in June 1978. However, the replacement applied only to those parts not already covered by IAS 37 provisions, contingent liabilities and contingent assets, which had been introduced in 1998. In December 2003, the International Accounting Standards Board issued a revised version of IAS 10 with a modified title, Events After the Balance Sheet Date. This revision was part of the board's initial agenda of technical projects. Later, due to changes in terminology introduced by IAS 1 presentation of financial statements in 2007, the title of IAS 10 was changed to Events After the Reporting Period. In addition, several other standards have made minor consequential amendments to IAS 10 over the years. These include IFRS 13 Fair Value Measurement, issued in May 2011, IFRS 9 Financial Instruments, issued in July 2014, and the amendments titled Definition of Material to IAS 1 and IAS 8, issued in October 2018. International Accounting Standard 10 events after the reporting period, IAS 10, is presented in paragraphs 1 to 24 and includes an appendix. All these paragraphs carry equal authority, even though the standard retains the format originally used by the International Accounting Standards Committee, IASC, when it was later adopted by the International Accounting Standards Board, IASB. This standard should be interpreted in the context of its stated objective and the accompanying basis for conclusions, as well as the preface to IFRS standards and the conceptual framework for financial reporting. In situations where explicit guidance is not provided within IAS 10, reference should be made to IAS 8 accounting policies, changes in accounting estimates, and errors to determine the appropriate accounting policy. The objective of IAS 10 is to establish the principles that determine when an entity should adjust its financial statements for events occurring after the reporting period. It also sets out the disclosures an entity is required to provide regarding the date when the financial statements were authorized for issue and about events occurring after the reporting period. Additionally, the standard requires an entity to cease preparing its financial statements on a going concern basis if events after the reporting period reveal that the going concern assumption is no longer appropriate. IAS 10 applies to the accounting for and disclosure of events that occur after the reporting period. These are events, both favorable and unfavorable, that happen between the end of the reporting period and the date when the financial statements are authorized for issue. According to IAS 10, events after the reporting period refer to events, whether favorable or unfavorable, that occur between the end of the reporting period and the date on which the financial statements are authorized for issue. These events are divided into two types. The first type includes events that provide evidence of conditions that already existed at the end of the reporting period. These are called adjusting events after the reporting period. The second type includes events that indicate conditions that arose after the reporting period. These are referred to as non-adjusting events after the reporting period. The date when financial statements are authorized for issue depends on the entity's internal management structure, legal requirements, and the procedures it follows to prepare and finalize the financial statements. In certain cases, an entity may need to present its financial statements to shareholders for approval after they have already been issued. However, the financial statements are considered authorized for issue on the actual date they are issued, not on the later date when shareholders give their approval. In this example, although several important dates follow the completion of the draft financial statements, the key date for determining when the financial statements are authorized for issue is the 18th of March 20X2. That is the day the Board of Directors reviewed and officially authorized them for issue. Later events such as announcing results, distributing the financials, shareholder approval, or regulatory filing do not change the fact that the financial statements were authorized for issue on the 18th of March 20X2. In certain situations, when an entity's management must submit the financial statements to a supervisory board composed entirely of non-executive members for approval, the financial statements are considered authorized for issue at the point when management gives its approval to release them to that supervisory board. This means the authorization date is when management approves sending the statements, not when the supervisory board actually approves them. On the 18th of March 20X2, the management of an entity approved the financial statements for issue to its supervisory board, which consists entirely of non-executive members, potentially including employee representatives and other external interests. The supervisory board gave its approval to the financial statements on the 26th of March 20X2. The financial statements were then made available to shareholders and other stakeholders on the 1st of April 20X2. Subsequently, the shareholders approved the financial statements at their annual meeting on the 15th of May 20X2, and the financial statements were filed with a regulatory authority on the 17th of May 20X2. The date the financial statements are considered authorized for issue is the 18th of March 20X2, which corresponds to when management authorized their release to the supervisory board. Events after the reporting period encompass all events that take place up until the date when the financial statements are authorized for issue. This includes events occurring even after the public announcement of profit or other selected financial information. An entity is required to adjust the amounts recognized in its financial statements to reflect adjusting events that occur after the reporting period. Examples of such adjusting events include those that provide additional evidence of conditions existing at the end of the reporting period. These events may require the entity to modify amounts already recognized or to recognize items that were not previously recorded in the financial statements. If, after the reporting period, a court case is settled that confirms the entity had a present obligation at the end of the reporting period, the entity must adjust any previously recognized provision related to that court case in line with IAS 37 provisions, contingent liabilities, and contingent assets, or recognize a new provision if none was previously recorded. The entity should not simply disclose a contingent liability because the settlement provides additional evidence of the obligation existing at the reporting date, which requires adjustment rather than mere disclosure. If information is received after the reporting period indicating that an asset was impaired at the end of the reporting period, or that the amount of a previously recognized impairment, loss for that asset requires adjustment, the entity must adjust the financial statements accordingly. For example, the bankruptcy of a customer occurring after the reporting period typically confirms that the customer was credit impaired at the reporting date. Similarly, the sale of inventories after the reporting period can provide evidence about their net realizable value at the end of the reporting period, which may require adjustment. If, after the reporting period, the cost of assets purchased or the proceeds from assets sold before the end of the reporting period are determined, the entity should adjust its financial statements to reflect this information. Similarly, if the amount of profit sharing or bonus payments is determined after the reporting period, and the entity had a present legal or constructive obligation at the reporting date to make such payments due to events before that date, the financial statements must be adjusted accordingly. Additionally, the discovery of fraud or errors after the reporting period that indicate the financial statements were incorrect requires the entity to adjust the amounts previously recognized. An entity should not adjust the amounts recognized in its financial statements for non-adjusting events after the reporting period. For example, if there is a decline in the fair value of investments between the end of the reporting period and the date the financial statements are authorized for issue, this decline typically reflects circumstances that arose after the reporting period. Since these changes do not relate to conditions existing at the reporting date, the entity does not adjust the recognized amounts or update the disclosures for those investments. However, the entity may be required to provide additional disclosures about such events. If an entity declares dividends to holders of equity instruments as defined in IAS 32 Financial Instruments Presentation, after the reporting period, it must not recognize those dividends as a liability at the end of the reporting period. Even if dividends are declared after the reporting period but before the financial statements are authorized for issue, they are still not recognized as a liability because no obligation exists at that time. Instead, such dividends are disclosed in the notes to the financial statements in accordance with IAS 1 Presentation of Financial Statements. An entity should not prepare its financial statements on a going concern basis if after the reporting period, management decides to liquidate the entity or to stop trading, or if there is no realistic alternative other than to do so. This means that if events occurring after the reporting period indicate that the business cannot continue operating as usual, the financial statements must reflect this change and should not assume the business will keep running. A deterioration in operating results and financial position after the reporting period may signal the need to reassess whether the going concern assumption is still appropriate. If it is determined that the going concern assumption no longer applies, the impact is so significant that the standard requires a fundamental change in the basis of accounting rather than simply adjusting the amounts already recognized under the original accounting basis. IAS 1 requires that certain disclosures be made if the financial statements are not prepared on a going concern basis, or if management is aware of material uncertainties related to events or conditions that may raise significant doubt about the entity's ability to continue as a going concern. These events or conditions that need to be disclosed might arise even after the reporting period. An entity must disclose the date when the financial statements were authorized for issue, as well as who gave that authorization. If the entity's owners or others have the power to amend the financial statements after they have been issued, the entity must disclose this fact. This information is important for users to understand because the financial statements do not reflect any events that occur after the date of authorization. If an entity receives new information after the reporting period about conditions that existed at the end of the reporting period, it must update any related disclosures to reflect this new information. Sometimes an entity needs to update the disclosures in its financial statements based on information received after the reporting period, even if this information does not change the amounts recognized in the financial statements. For example, if new evidence about a contingent liability that existed at the end of the reporting period becomes available, the entity should update its disclosures about that contingent liability accordingly. This is in addition to considering whether it needs to recognize or adjust a provision under IAS 37. If non-adjusting events after the reporting period are material, failing to disclose them could reasonably influence the decisions of the primary users of general-purpose financial statements, which provide information about a specific reporting entity. Therefore, an entity must disclose for each material category of non-adjusting event after the reporting period the nature of the event and either an estimate of its financial effect or a statement that such an estimate cannot be made. Examples of non-adjusting events after the reporting period that generally require disclosure include a major business combination that occurs after the reporting period, as IFRS 3 business combinations mandate specific disclosures in such cases, or the disposal of a major subsidiary. Other examples include announcing a plan to discontinue an operation, making major purchases of assets, classifying assets as held for sale in accordance with IFRS 5 non-current assets held for sale and discontinued operations, other significant disposals of assets, or the expropriation of major assets by the government. Other examples of non-adjusting events after the reporting period that would generally require disclosure include the destruction of a major production plant by fire after the reporting period, announcing or starting the implementation of a major restructuring, and significant ordinary share transactions or potential share transactions occurring after the reporting period. IAS 33 earnings per share requires entities to disclose descriptions of such transactions, except for capitalization or bonus issues, share splits, or reverse share splits, which must be adjusted under IAS 33. Other examples of non-adjusting events after the reporting period that generally require disclosure include abnormally large changes in asset prices or foreign exchange rates after the reporting period, changes in tax rates or tax laws enacted or announced after the reporting period that significantly affect current and deferred tax assets and liabilities, entering into significant commitments or contingent liabilities such as issuing major guarantees, and commencing major litigation that arises solely from events occurring after the reporting period. This standard is required to be applied for annual periods beginning on or after January 1, 2005, although earlier application is encouraged. If an entity applies the standard to a period starting before that date, it must disclose this fact. Additionally, IFRS 13 fair value measurement, issued in May 2011, amended paragraph 11 of this standard, and entities must apply that amendment when they apply IFRS 13. Similarly, IFRS 9 financial instruments, issued in July 2014, amended paragraph 9, and entities should apply that amendment when they apply IFRS 9. The definition of material, which includes amendments to IAS 1 and IAS 8 issued in October 2018, amended paragraph 21 of this standard. Entities are required to apply these amendments prospectively for annual periods beginning on or after January 1, 2020, although earlier application is allowed. If an entity chooses to apply these amendments to an earlier period, it must disclose that fact. These amendments should be applied in conjunction with the amendments to the definition of material found in paragraph 7 of IAS 1 and paragraphs 5 and 6 of IAS 8. This standard replaces IAS 10 events after the balance sheet date, which was revised in 1999. The amendments in this appendix are to be applied for annual periods beginning on or after the 1st of January 2005. If an entity applies this standard for an earlier period, these amendments must also be applied for that earlier period. The amendments included in this appendix, made when the standard was revised in 2003, have already been incorporated into the relevant IFRSs published in this volume. International Accounting Standard 10, Events After the Balance Sheet Date, revised in 2003, was approved for issue by the 14 members of the International Accounting Standards Board. The board members included Sir David Tweedy as chairman, Thomas E. Jones as vice chairman, Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gillard, James J. Laysenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmidt, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qllever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.